Well, Taryn, these wealth taxes kinda suck, huh?
Sure, but in fairness, you hate all taxes.
Yeah, I know. Taxation is theft. But I heard that the wealth tax was a really big failure, especially over there in Europe.
Oh, that's a story in and of itself. But first, what's a wealth tax? Net wealth taxes are recurrent taxes on individual net wealth stocks, and they are levied on an annual basis. The number of wealth taxes has fallen as back in 1990, there were 12 OECD countries who used them, but in 2020, only 3 OECD countries, Norway, Spain, and Switzerland, still levy wealth taxes. So what happened? Well, a number of things. When looking over a 50-year period, starting from the mid-1960s, most countries with a wealth tax saw their revenues remain stable or decline over time. But this is quite surprising, since some studies have demonstrated that household net wealth has risen considerably, but this somehow didn't translate to higher wealth tax revenues. Wealth taxes usually account for both a small portion of tax revenues and GDP, with net wealth taxes being the least common form of taxation within the OECD. Switzerland seems to be the most successful in generating wealth tax revenues, with 3.9% of their revenues coming from the wealth tax. Moreover, Switzerland has relatively low tax thresholds for the wealth tax, but one of Switzerland's canton had a threshold of $55,000 to qualify for a tax on wealth, in comparison to Norway's €150,000 per person. By the way, from comparison, the euro and dollar are pretty similar in terms of exchange rates. So, is Switzerland the only country that has managed to avoid the wealth tax curse? Well, I don't think the Swiss should be that optimistic, because the country doesn't levy capital gains taxes, and most cantons don't have inheritance or gift taxes. So these wealth taxes may just be a revenue substitute for the lack of these taxes.
I've also heard something about the tax was applied on people with very, very little wealth. That sounds kind of regressive, doesn't it?
Oh yes, there had been a trend of increasing wealth tax exemption thresholds in order to avoid hurting the middle or upper class, and even lower rates for the wealth tax. Why?
That's right, Mr. Theron. Do you know why the middle class need lower rates? Because of wealth inequality. Within 18 OECD countries, the bottom 3% own only 3% of total household wealth, while the top 10% own the top half of household wealth. To make matters worse, the main culprit, the 1%, own nearly a fifth of household wealth. The middle class is getting squeezed, while the rich get richer and the poor get poorer.
Oh dear God, why does this socialist have to be here? This is a video about Europe. This feels kind of like clout chasing. You know, kind of like how Taryn made videos mostly about America for over a year, rather than Europe and the country he currently lives in. Oops. Sorry, Taryn.
Yes. Thank you, Bernie and, Mikail. Regardless, with perceptions of rising wealth inequality becoming more popular, a wealth tax has gained international appeal, such as in the UK and US. For comparison, we can look at France, which has a similar population size and economic output to the UK, with its wealth tax that was abolished back in 2017. The wealth tax generated rather disappointing revenues, and many attribute this to large amounts of rich people leaving France. For instance, in 2016, more than 12,000 millionaires left France, and the 16 years up to that point, the country dealt with a net outflow of over 60,000 millionaires. One French economist estimated that France lost twice as much revenue as it generated, with even lower GDP growth among other metrics.
Aha. So the European wealth tax has failed because the rich left the country hurting tax revenues.
I'm not sure if we can say that.
Wait, huh? What do you mean?
What I mean to say is, it is possible these millionaires actually left France because of the wealth tax, but we aren't exactly sure, even if the tax was a failure from a revenue perspective. It is hard to determine what motivated such a large exodus, especially since these mass exoduses from France coincided with changes that generally lowered tax burdens for the very wealthy, and the studies don't account for those who leave because they anticipate future rises in wealth taxes. And the migration numbers would make a small fiscal hole in lost revenue for international wealth taxes. Migration was much larger regionally rather than internationally, but these studies still point to limited mobility for wealth taxes in general. Regardless, one of the problems with the wealth tax was perpetuating inequality, which, as you saw, Bernie Sanders has a certain fixation with. When the tax is applied to assets that can generate an income for the owner, the tax will not change regardless of how large the return is. So an asset that has no returns and an asset that has large returns receive the same tax. This means an asset with higher returns has a lower effective tax rate. So wealthy people benefit more. To make matters worse, there could be liquidity issues as people with illiquid assets, like houses, could be forced to sell them to pay the tax in the first place. This is why there must be a high exemption threshold, which many European states didn't have. But even with a high threshold, people whose wealth is tied to a private business would still have liquidity problems. There has been an argument that this regressive aspect of a wealth tax will force people to make a more productive use of assets, and that the tax will lower investment in low-yielding assets and not investment overall. But this argument may have flaws, since it can be argued that market returns don't reflect productivity, but pure luck or privileged market access. So this could be even more unfair or regressive.
So the wealth tax can actually increase inequality. Wait until Bernie hears this.
Indeed. Moreover, there have been concerns that a wealth tax could hurt innovation and distort savings.
So the wealth taxes all over Europe sucked because it hurt investment, creativity, and savings. That sounds typical of taxation. I told you it's theft.
Actually, that isn't the case.
Wait, what do you mean?
You see, Mikail, most innovation comes from young people than wealthy people who tend to be much older, so young innovators are very unlikely to be affected by the tax if there's a high wealth tax threshold. Businesses who expand to more of a monopoly to stifle innovation would be more affected by a wealth tax. There's little evidence that a wealth tax makes the wealthy less innovative, and the evidence on savings has been mixed, with some suggesting a low response from savings. However, this could be because of a narrow tax base and numerous opportunities for tax avoidance and evasion, which we will hit on later. If there was a large tax base with a minimal ability to evade/avoid tax, we might be able to see if there was an impact on such behaviors.
Okay, so what is the actual reason that the European wealth taxes failed? You know, the actual title of this whole video? Okay, we now know that wealth taxes don't affect innovation, have a mixed effect on savings, and that there's not enough evidence to check if it affects wealthy migration. Okay, cool. So, the closest we got is that the wealth tax actually increases inequality, which is kind of ironic, don't you think?
Okay, fair enough. Don't worry, we have finally gotten to the good part. And just before I mention it, to my viewers, please type in the live chat or the comments what you guys think is the main reason that European wealth taxes failed. Have you typed it yet? Great. The reason for a narrow tax base is due to tax exemptions and reliefs. These exemptions include pension assets, primary residences, business investment, artwork, jewelry, and antiques. But these exemptions aren't exactly unjustified. For example, it is kind of sadistic to tax the wealth of pensioners who can't work anymore. Even though many of these exemptions are necessary, they limit the amount of revenue that these wealth taxes can generate. It is also more inequitable, especially for exemptions that are applied on assets that are mostly held by the wealthiest of taxpayers, which creates some opportunities for tax avoidance. Moreover, preferential tax rules, which these exemptions effectively are, increase the complexity of wealth taxes. This leads to higher administrative costs for the government and higher compliance costs for taxpayers. I don't think I have to tell you that if the cost of tax collection is too high, then it kind of defeats the purpose of collecting tax revenues in the first place. Still, despite the downsides of exemptions, the general trend is countries that adopt wealth taxes gradually increase exemptions and reliefs, suggesting that such a phenomenon is inevitable. probably because you can't justify a wealth tax on various groups in society, and some would say no group at all.
Oh, you mean like me? Yeah.
Another reason for why these wealth taxes failed is tax evasion. You can simply just not report foreign income or assets if domestic tax authorities can't access that information, and factors like increasing capital mobility and tax havens don't help, with the top 0.01% of the wealth distribution owning roughly half of the wealth in tax havens. This same group also evades 25% of their income via hiding foreign assets and investments. Furthermore, some forms of wealth are difficult to value, and regularly updating asset values increases the cost of tax compliance and administration further. And even if you decide to update assets less frequently, it may increase distortion and reduce fairness. These valuation problems incentivize more of the wealth tax exemptions and tax avoidance we mentioned before. Although, there are a few silver linings, like using methods for property tax to value these assets, insurance values for jewelry/artwork, or book value plus the weighted average of earnings value for small businesses, when market value is difficult to find. But even with some of these, there are still drawbacks, like property assets, which tend to be undervalued, and intangible assets may still be a problem. These valuation problems highlight the advantage of an inheritance tax, where valuation only occurs once when the wealth tax is transferred from the deceased to the recipient, and these valuation difficulties were another reason why these hard-to-value assets were exempted. Not to mention that the complexity that arose from exemptions and special tax treatments had affected the efficiency and distributional effects of wealth taxes. A common retort from Swedes against the tax was that it affected middle-class wealth while being avoided by the wealthiest of individuals. Other reasons for these exemptions were also lobbying from special interest groups, but they also campaigned and built coalitions against wealth taxes. Popular political framings/narratives, arguments for business investment, and governments copying each other also helped contribute to the elimination of wealth taxes. Just to reiterate, wealth tax bases are narrowed because of tax exemptions and reliefs. There was significant evasion of the tax, there were difficulties in valuing the wealth, and that there were high administrative and compliance costs for these wealth taxes. But have times changed? The authors of the study I'm using think so. Since the massive repeals of these wealth taxes, there has been rising wealth inequality, which has not been ignored by the populace, and greater international tax transparency. In addition, legislators and politicians can look at the history of these European wealth taxes and attempt to improve on them. Better designs could include broader wealth tax bases, measures to lower valuation costs and liquidity risks, as well as so-called tail provisions that place a minimum period for a lever to be subject to the tax. There are, of course, constraints to some of these designs, such as fiscal exile in areas with freedom of movement, and political opposition to broader tax bases. Outside the scope of these designs, international tax transparency has improved thanks to two standards of information exchange. The first being the exchange of information on request, where tax authorities from different regions can request information from each other for tax investigations. The second is the automatic exchange of information, where financial account information of non-residents are automatically exchanged on an annual basis with the tax jurisdiction of the non-resident. From the latter, nearly 100 countries exchanged information in 2019, where tax authorities have data on 84 million financial accounts with assets of 10 trillion euros. These tax transparency standards have enabled countries to tax capital income and assets much easier, as it's harder to evade tax by concealing assets overseas. 102 billion euros in tax revenue has been found from offshore accounts. However, the automatic exchange of information has been associated with a 22% decline of bank deposits in international financial centers owned by individuals residing in non-international financial center jurisdictions.
Well, regardless of future wealth tax prospects, Europe's wealth taxes are an absolute failure. So I guess that's the end of them, isn't it?
Well, actually...
Oh, come on! Can't we just rip them out of the history books? Burn them and send the ashes into the cosmos, please, come on!
Sorry, but remember when I was talking about how politicians can improve on wealth taxes? Well, US Senators Elizabeth Warren and Bernie Sanders have actually proposed wealth tax plans prior to the 2020 election. And say what you want about them, but they are vastly different from the previous wealth taxes tried in Europe. Warren's plan taxes wealth above $50 million at 2% and above $1 billion at 3%, while Bernie would tax at 8% for those above $10 billion. The brains behind their wealth tax plans have appeared to have taken account of tax competition and migration within Europe, as a common tax policy required to rein in tax migration would require the unanimity of all EU member states. EU states also don't tax their nationals living abroad. This is in contrast to the US, where the IRS will still tax you, even when you move away, and the only way to avoid this is to renounce your citizenship. But even in this scenario, Warren and Sanders' hypothetical plans would place a 40% exit tax for those who no longer want to be a US citizen on their net worth. Although, as stated before, there is no significant evidence or way to tell if tax migration hurt wealth taxes. Europeans also weren't able to rein in as much tax evasion, especially since they didn't require banks in Switzerland to share information with tax authorities until 2018. In contrast, Obama's Foreign Account Tax Compliance Act forces foreign financial institutions to send detailed information to the IRS about their US citizens or face sanctions. Almost all foreign banks agree to this. Warren and Sanders also want to fund the IRS more, as they consider it underfunded, and hence are not utilizing this information in the best way possible. They even address the loophole problem, as they have argued that this was mostly due to a low wealth tax threshold set. Warren's plan will be a $15 million threshold, while Sanders is $32 million in contrast to Europe's roughly $1 million threshold. Of course, there are concerns that high thresholds could, quote, encourage taxpayers to split their assets and make wealth taxes highly sensitive to behavioral responses and migration, unquote. Nevertheless, a counterpoint to that would be the US citizenship exit tax as mentioned before. The advocates of Warren and Sanders' plans may be a bit sympathetic to liquidity concerns, but would find the idea that, for example, someone worth $100 million unable to pay a $1 million tax ridiculous. The disdain for the ultra-wealthy is compounded by their research that the wealthiest 400 Americans pay 23% of their income in taxes, which is less than what the working and middle classes pay.
Okay, so do you think their wealth taxes will be a failure in America just like they were in Europe?
Well, I don't know, but I plan on finding out by first analyzing Elizabeth Warren's wealth tax plan via a new video, and once that's out, I may respond to various progressives on the wealth tax, like TYT, Robert Reich, and Twitch streamer Denims. A wealth tax saga of sorts.
Well, sounds great. As always, it was a pleasure working with you on this vid, and as always, live free or die trying.
Oh, thank you Mikail for lending your voice. A centrist buddy of mine, Layman, also provided his voice for Bernie Sanders, and both their YouTube and Twitter links are in the description and pinned comment. Moreover, Mikail is doing a series on reading Thomas Sowell's book on basic economics, which I recommend you guys watch. Anyways, I hope you enjoyed this video. If you did, please give a like and comment, as it really helps my video in the YouTube algorithm. And if you like economics and political commentary, consider subscribing. Maybe follow me on my Twitter, and see you later.